MyWealth.com. I'm Mike Conlon. I'm one of the senior instructors with the courses. Welcome to today's blog. Today's blog is entitled, Sound as a Pound, for now. Yesterday, the Bank of England voted unanimously to leave the size of its asset purchase plan unchanged at £175 billion and voted to leave interest rates unchanged at 0.5%. This is seemingly good news for the pound in the near term, as currency markets are reflecting this morning. The British pound is up versus all other currencies. Okay, but what's the outlook for GBP going forward? Back in August at the B of E, there were some who had wanted even more quantitative easing, yet were comfortable with following through with the plans laid out in August, okay, as the September minutes now show. So while economic conditions may have stabilized in the UK, just enough to warrant a continuation of that policy, okay, is a full-blown recovery underway? Methinks not. Let's take a look at a few factors that could weigh heavily on the British pound and what this means for other markets as well.
As always, be sure to check out the written blog at www.mywealth.com/blog. Okay, so the British are commonly known as more conservative than Americans. Well, outside of talking about personality traits, why is that important? Well, if you notice what happened, when we had the credit crisis, the Americans were quick to jump to, the worst case scenario conclusion, and we just started throwing money at the problem. We had the original TARP and TALF funds that came out, and basically it was just asking for a blank check from the government to try and help stabilize the banks. Well, the British didn't react quite as quickly and quite as some might say quite as hastily. What they've done is they've actually kind of waited to see what's going to happen, and then they take a measured approach, and they kind of do it little by little. So rather than just throw the whole kit and caboodle at it, they're going to wait and see kind of what happens. Now that some people will say, well, that's a little bit more reactive than proactive, and that's quite possible. But at the end of the day, how this plays out, we're not going to be quite certain until that really happens. So in this regard, that leaves a lot on the table, so to speak, for the British to take further action. All right, now what this means is that they could go down the road of further quantitative easing. All right, now they came up with a plan back in August, which at the time was a little bit surprising to the economic community, because they are known for being conservative. Well, there were actually folks on that Bank of England board who wanted to actually do more than what they currently did. Now, we mentioned the £175 billion program that they're sticking with, okay, to purchase assets, okay, but there were some on the board that actually wanted to do more than that, so they weren't quite certain how it's happened. Well, it looks like they've stabilized a little bit, and now they're thinking, well, this is pretty good, so we're just going to stick with this course right now. Okay, but what's happened is that the British Bankers Association just reported that loans for home purchases declined from the previous month, and they missed the expectations. So they were expecting there to be more loans taken out. All right, now this, if this isn't the start of a trend reversal, okay, what this could mean is that, you could slow demand for home purchases there, which could further depress prices. And if you get further depressed prices there, then what's going to happen is that people aren't going to be as quick to run out and spend because they're not going to feel as wealthy, because they're losing value in their homes, which in turn is then going to help slow their economic recovery. All right, so if this occurs, this could mean that they're actually going to be dealing with a little bit more deflation, okay, and not inflation as they're hoping for. Pretty much all central bankers around now are hoping for some sort of inflation. I mean, they're going to sit there and tell you, well, no, we don't want inflation, that's bad, rah, rah, rah. But at the end of the day, they're all hoping for a bit of inflation so that asset prices can get back to the point where people can, begin to feel good about themselves again, go out, spend money, stimulate the economy so that they can move forward and recover economically. All right, what's that going to mean for the British pound? Well, I don't think the GBP is going to decline versus the U.S. dollar, okay, because we've already talked about, if you read my blog on Monday, we talked about the Bernanke's policy with regard to having weak dollars. He's attempting to inflate out of it. He's not going to do anything to change that because he doesn't want to spook the stock market here, and he doesn't want to throw the recovery off track. All right, but what this could foreshadow is that the U.S. stock market could be a little bit weaker later on in the year. So right now, you've had a lot of people, call market contrarians or stock market bears, who keep saying, well, the market's got to go down, the fundamentals aren't good, and you hear that a lot, but, the market's done just the opposite. So this could be what they're looking for as far as the market's selling off a little bit and taking back. So if that happens, then you're probably going to see British pound decline as well. Now, it's hard to say, well, which comes first. It's sort of like which comes first, the chicken or the egg. Is the pound going to decline and thereby take down the U.S. stock market, or is U.S. stock market going to decline, thereby taking down the pound? So it's hard to determine, but basically when either one of them happens to go, the other one goes as well. And that's because there's a pretty tight correlation between the two. I want you to take a look at this chart here. Okay, this is a 3-year chart. This is the S&P 500 here in the yellow, and the FXB, which is the British Pound ETF. Okay, so as you see, they have a tight correlation. Okay, this last 3 years they move as British Pound's going down, so is S&P. As S&P's coming up, so is British Pound. So it kind of gives you an idea of what these correlations are. So how this is going to play out is anyone's guess. But as you can see, there's still a lot of weakness out there, and if one should break, then you watch for the other to happen as well. So don't wait. Get educated. Get in the course. Okay, come to www.mywealth.com and learn about how foreign economies can affect your investments.
Should the U.S. stock market run out of gas later this year, this could coincide with British pound weakness as a result of sluggish economic growth in the UK. This could be the double whammy that the stock market bears have been looking for. But until that occurs, keep your eyes on the British economy, and remember, don't fight the Fed. To learn more about how currencies and foreign economies can affect your investments, be sure to check out our currency trading course. So I'm Mike Conlon. Thanks for being with me, and I hope to see you in that course.